All right, fellow AMC stockholders, XMAX Trading here. We're going to go over this most important DD. This is amazing news that came out about short selling probe from the DOJ, not from the SEC, but whatever. So let's get started. Go and subscribe to the channel if you haven't already. Let's get at it. Hedge funds face expansive short selling probe, exciting critics. Yeah, no kidding. The U.S. Justice Department has launched an expansive criminal investigation into short selling by hedge funds and research firms, throwing legions of small investors and other skeptics of the tactics that investigate firms use to bet on stock declines. Investigative firms. Well, of course, I mean they're trying to point at the apes. The probe run by the department's fraud section, with federal prosecutors in L.A., digging into the symbiotic relationship between funds and researchers, hunting for signs they improperly coordinated trades or broke other laws to profit. According to people familiar with the matter, the government is examining how the investors handle information and set up their bets, especially in the run-up of publication of reports that move stocks. Authorities are looking for signs that money managers sought to engineer startling stock drops or engage in other abuses, such as insider trading, to two of the people asked not to be named because inquiries are confidential. News of the broad investigation on Friday set a flurry of celebration across Reddit, StockTwits, and Twitter, where small day traders have long rallied against what they see as stock market manipulation by Wall Street's establishment. Their complaints set the stage for this year's surge in so-called meme stocks, and even won sympathy from members of Congress, who've called for more scrutiny of the market. With that charged backdrop, the Justice Department will have to be careful to zero on blatant wrongdoing, said John Caffey. They don't want to look like they're criminalizing conduct that was formerly only actionable civilly. It would be the traditional pattern of prosecutors, particularly in the first case they bring, to search for a case that has badges of fraud. For example, bribes or clear insider trading. Underscoring the inquiry sweep, federal investigators are examining trading at least several dozen stocks, including well-known short targets such as Luckin Coffee, Bank of California, Mallinckrodt, and GSX. And they're scrutinizing the involvement of a dozen or more firms, so it's not clear which ones, if any, may emerge as targets of the probe. Toronto-based Anson Funds and anonymous researcher Marcus Aurelius Value among the firms involved in the inquiry, people said. Other prominent firms that circulated research on stocks under scrutiny include Carson's Blocks, Muddy Waters Capital, Andrew Left's Citron Research. Citron. I think that was involved in GameStop. The U.S. probe opens yet another front in an already treacherous era for those ready to profit from stock drops. Some bearish funds threw in the towel as government stimulus buoyed prices during the pandemic. That pressure intensified as retail organized counterattacks on popular short targets, bidding up shares to inflict losses on hedge funds this year. By late January, Citron vowed to give up short selling and focus on long bets. Meanwhile, companies criticized by short sellers have become increasingly bold in firing back, sometimes launching legal battles as they face government probes that ultimately support short sellers' thesis. Even as they face government probes that ultimately support short sellers' thesis, a number of corporate executives have been hoping U.S. authorities might help to further shift the focus to investors' tactics. Still, successfully bringing charges against short sellers could be challenging, given that betting against companies and publishers and research believed to be accurate is lawful and even beneficial to markets. So far, nobody has been accused of wrongdoing, and authorities may ultimately decide not to pursue charges. Nuts. Government attorneys are trying to determine whether short sellers engage in some form of deception by misleading the public about their financing or what appears to be independent research, violating confidentiality agreements with authors, or orchestrating stock plunges to panic shareholders and exacerbate selling. Yeah, that happens. Spokesman for Justice Department and Muddy Waters declined to comment. No response from Anson Funds or Aurelius. An attorney for Citron says aware of the industry probe. He expressed doubts that the theories were borne out. Citron Capital and Mr. Left are successful because they do quality research and keep the reports secret from other short sellers until publication, said the lawyer. There is simply no truth behind any theory that short sellers coordinate among themselves before publishing reports, at least in regards to publications by Citron and Andrew Left. I'm hopeful that anyone investigating the issue will reach the conclusion as soon as possible. Authorities are prying into financial relations between hedge funds and researchers, according to People. Such firms are widely known, are a known wide variety of deals, with funds paying researchers handsome subscription fees for fresh insights into possible corporate trouble, or even becoming an author's primary source of funding. Uh-oh. In one example, prominent financial investigator Harry Markopoulos, who normally makes money from whistleblower awards, said he partnered with a hedge fund to share profits when he released a report on GE. Some hedge funds have been known to suggest targets to researchers who then deliver scathing reports. One cautionary tale emerged in court after Dallas-based Sabrepoint Capital agreed to pay a short-selling researcher a monthly retainer of $9,500 in 2018. Sabrepoint encouraged him to dig into real estate company Farmland Partners. The researcher used a pseudonym, published an article on Seeking Alpha, setting off a 39% drop in Farmland's price. The company sued and used a judge's order forcing him to reveal his identity, Quentin Matthews. Matthews later said in a statement that he subsequently learned his article contained inaccuracies and false allegations and retracted it. He and Farmland reached a settlement. Sabrepoint said he didn't know about the Seeking Alpha article. Yeah, he didn't know. Farmland is on a list of stocks the Justice Department is examining as it looks at short sellers. Lawyers for Sabrepoint and Matthews declined. The Justice Department unit handling the inquiry already has formidable reputation on Wall Street. It recently brought several cases against global banks and traders for illegal spoofing of precious metals and treasury futures. As part of that probe, J.P. Morgan Chase paid out more than $900 million in penalties after its traders placed and canceled orders for commodities to benefit positions held by the bank or prized hedge fund clients. Those cases were brought by analyzing trading data for suspicious patterns and then attributing to individual traders. While prosecutors in the short selling investigation issued subpoenas as recently as October, the effort has been underway much longer, people said. The inquiry gained momentum after U.S. lawmakers called for more scrutiny of short sellers following the meme stock trading frenzy in January. Retail investors sent the price of GameStop soaring 700% before brokerages began limiting bets. Some organizers of the buying spree claim hedge funds have been unfairly using market clout to drive down stocks. Lawmakers have since held multiple hearings on the fracas, at times discussing whether to force short sellers to boost disclosures. Concerns about how short sellers carry out attacks has repeatedly over the years. The SEC and DOJ have gone after hedge funds running rampant short and distort campaigns. The practice typically involves setting up bearish bets, then releasing misleading or inaccurate information about a company to drive the price down before closing the position for a profit. Yep. But then there's also concern about the impact of earnest research can have when it's sprung by surprise on the market. Studies by Columbia law professor Joshua Matz has found that short sellers reports can briefly induce bouts of panic selling before shares rebound. In those jittery moments, sometimes mere minutes or hours, well-positioned short sellers can cash out of trades and pocket significant gains. Matz examined more than 700 reports by pseudonymous short sellers from 2010 to 2017. Concluded they contributed more than $20 billion in dislocated values or temporarily mispriced stocks. Academics have encouraged U.S. authorities to address the possibility that short sellers are laying out their case against stocks, then using the impact of that news to reap gains and quietly move on. Last year, Mitz Coffey and most of a dozen other securities laws professors urged SEC to write rules requiring that short sellers who voluntarily reveal bets against a stock be required to disclose when they've exited the position. The professors also asked regulators to write a new rule that would make closing a short position immediately after sending a negative report, when they intend to do so upon a publication, constitute market manipulation. Yeah, short and distort, those bears always up to no good, trying to get into the honeypot. So, pretty amazing things. I think the fact that they disclosed this, that this probe is ongoing, means that they've probably found some evidence. They're kind of, maybe they're trying to get people to cooperate, get some witnesses going. But yeah, short and distort. You see all those FUD articles about AMC trying to pump it down, drag it down. So anyway, guys, until next time, let's keep on AMC, not financial advice. Keep on going. Later.